As the first publicly traded gig economy company, GrubHub is sinking. Hey everyone, welcome to the Entrepreneur Vlogs. I am your host, Kevin. This is the second channel. Now, I'm putting this story on the second channel because, I have not had that much luck with the food stories on the main Entrepreneur channel, so we're going to try it here on the vlogging channel, see if it makes a difference. But let's talk about GrubHub, because GrubHub is interesting. It always has been very interesting to me because they are, unknown to most people, the only gig economy company that's actually trading on the stock market as far as I'm aware. I don't know if Blue Apron actually counts as gig economy. I think they trade too, but GrubHub does trade on the stock market under GRUB, just to let you know in case anyone wants to buy stock. But their stock has been hammered recently, like totally hammered, and they are losing tons and tons of market share to UberEATS and DoorDash. And according to this article, well, the analysts are not predicting a pretty future. So here's the article, and this is the founder and CEO, Adam Jeffrey, by the way. GrubHub sank 8% on Tuesday after analysts from KeyBanc Capital Markets said the food delivery service is struggling to keep customers amid increased competition from DoorDash and Uber. For GrubHub, diner retention, initial diner spend, and peak diner spend all appear to be deteriorating, wrote the analysts who have the equivalent of a hold rating on the stock and a price target of $74.98. The shares reached a low of $70.36 after the report. Uber has doubled down its food delivery service, UberEATS, in recent months as it prepares for an IPO that could value the company at well over $100 billion. We'll see if that actually happens. But the bigger share losses for GrubHub, according to KeyBanc, have come at the expense of DoorDash, which raised its last round of valuation of $7.1 billion. SoftBank is Uber's largest investor, and the firm led a $535 million investment in DoorDash last year. Now, as you can see, they have included this chart, and you can see it was going up. It got up to close to about 150 at one point. This is over the last year, and as you can see, it's just been going down. And when this article was written, it actually had closed a little bit lower. In fact, I kind of wonder, what does GrubHub stock look like now? Let's GrubHub stock. What are they actually at now? $68.59. And after volume trading on Friday, it's going down even more. So, by the way, a $68 stock is not necessarily a bad thing. In fact, there's a lot of stocks I'd love to be $68 right now. But it's this is not the direction you want the company to be going. Let's go to the max. And at the height, they had $144.11, which was August 31st, 2018. Granted, it's a lot higher than it was when it started. So GrubHub is still doing, I would say, overall well, but this is a concerning trend for them. It definitely is. Let's go back to the story. DoorDash's gains began accelerating in second quarter 2018 and show little sign of slowing, the report said. GrubHub's customer retention started falling last year. In the third quarter, the company held on to only 36% of diners the following period, down from 42% retention in the fourth quarter of 2017 and 59% in the first quarter of that year, KeyBanc said. The bright spot for GrubHub, which has a stock market value of about $7 billion, is that the new diners are still trying the service at a fast clip. The analyst said that new diner growth averaged 28% over the previous 4 quarters, which reflects strong market adoption of online food ordering and Grub's increased marketing efforts. Still, among those 3 services, more than 40% of new diners in the market went to DoorDash, along with over 50% of their spending. Customers are increasingly using multiple platforms. Quote, while the current battle appears to be mostly for share of new customers, growing overlap could intensify the battle for existing customers through 2019 and 2020, the analyst wrote. Newer diners seem reluctant to spend more over time on GrubHub, the analyst said, suggesting declining perceived value. Moving forward, they wrote, GrubHub will have to add 3 times as many new diners in the third quarter of this year compared to 2018 to make up for the expected churn. I don't know what they mean by diners. Diners, like they're partners. Never mind that. Sorry. GrubHub shares have lost more than half their value since reaching a record in September. Prior to that, they'd been on a tear, multiplying by more than 7-fold since early 2018. Now, I kind of wonder like why it is that GrubHub is suffering. Well, actually, there might actually be a very solid reason. Like, I don't use GrubHub as a customer. I don't really use any of the food companies as a customer, or I very rarely do. I think the last time I used Postmates to get a pizza delivered, and after the tax and the tip and the delivery fee, it was like an extra $13 to get a couple pizzas delivered. And granted, yeah, we didn't have a car and we had hungry kids, and it was probably worth it in the long run. It's very expensive. I just prefer to spend my money other places, in other areas. But I definitely know that Postmates and DoorDash are getting way more aggressive about promotions, about discounts, about frequent buyer programs. I'm not aware of that GrubHub does all that. And here's one of the reasons why. GrubHub is publicly traded. They might not have the capital to just be giving away free deliveries. That's how you entice new customers to come forward. You either give them free deliveries or the deliveries are really cheap. And once you go public, you got to start making money. You can't just be giving your service away, especially since Grub doesn't have anything else. And GrubHub has kind of been a real big test to what could potentially happen to the gig economy stocks. In fact, let's go back over here. Like, look at this. I suspect this is what's going to happen with Uber and Lyft. It's going to kind of middle out. It might even go up a little bit, but at some point it will crash as more and more analysts and people realize there's not a lot of money to be made in it. So this is unsurprising. And I mean, of course, I wish GrubHub the best of luck. It would be ideal if they could figure out how to make their service profitable and how to pay their drivers and have a good service. And I do like the idea of apps where you can just order anything. The sad thing about all these apps is that I fundamentally believe in them as services. I believe that there's a model in there that could work. I don't know if it's mainstream though, because for it to be mainstream, it needs to be super cheap. And when it's super cheap, the companies don't make money. But could these things survive if only like 20% of the nation were using them? I mean, that's a good question, and I just simply do not know. In the meantime, GrubHub definitely has their work cut out for them. They're competing with DoorDash and UberEATS. It's interesting that Postmates wasn't listed here. That you'd think they would have mentioned Postmates here at some point, but you know, whatever. I guess that's the way the chips fall sometime. Anyway, what do you folks think about this? Do you think GrubHub is in trouble? Do you think they're going to bounce back? I would love to know. So, you know the drill. Comment below. Like, favorite, share, subscribe. If you enjoy my videos, consider becoming a Patreon member. It's totally optional, but doing a little $1 a month can go a long way to helping the channel run smoothly. Don't forget to join my Facebook group. It's fairly new, but we have a lot of fun there. And as always, flame responsibly. Have a good one.